the central banks will have to print, print, print. Their primary focus will be on the bond market and help and save the stock market as well. They won't admit that. That helps what? Gold and silver, because they're degrading the money units underlying their markets. And that's further fuel, panic fuel for gold. Now, the question then is, what about the top in silver? Yeah, there will be a point at which, let's say after the next 6 months, silver will go to a new reality and possibly even overshoot what you could consider to be the new reality. So if it's going to live in a range that's a couple $100, maybe it goes to 500 first.
Silver may be on the verge of a move so violent and so fast that most investors won't emotionally be prepared for it. While many believe silver's recent strength signals a late-stage top, a growing macro-technical framework suggests the opposite, that silver is only just beginning a structural repricing after decades of suppression. This isn't about hype or speculation. It's about ratios, historical precedent, and mounting stress across global financial markets. According to momentum structural analyst Michael Oliver, silver has just broken out of a multi-decade base. And history shows that when this happens, silver doesn't grind higher. It explodes.
We're arguing that don't be shocked if the price took out the range highs of the last 50 years. Why won't the spread maybe also challenge the highs of the last 50 years, one of which is over 3% and one over 6%? So everything we see regarding the monetary metals, and especially silver component of that, is freshly broken out and still cheap.
Okay.
So don't be shocked by a thunderbolt. Well, even what you just see there recently has been a thunderbolt, but
yeah,
a lot more to come. And again, that's not the way you top something to freshly break out of a decade-wide base.
You just
broke out. That's not the way you top.
Basically right there, right?
Yeah.
Like that box right there, the last 10 years, and we've now just gone above it.
And, 2%, by the way, if you go back 50 years, is commonplace. The number of the years that were at least 2% or higher, that lower line there, was 20 out of 50 years. So I would say fully expect at least silver to reach 2% the price of gold, and probably challenge or take out maybe one or both of those old highs, and do it quickly. Because if you look at those highs at 6.5% and 3+%, that surge was very rapid. And that's also when silver went ape on the upside during the latter phases of those bull trends, mid-79 to the 80 peak, or the September 2010 through April 2011 peak. In net price, silver exploded geometrically. And right now, I think our expectation is, frankly, you'll see silver in the couple $100 range within the next couple quarters. And when you look at gold, it expanded well beyond the 1980 high when it ran up to 2011, and then it pulled back, and then it's blown way beyond. In other words, it doesn't stay in a range like silver has. Now, why is silver still in the range of 1975 to 80 through 2011? Only just now has broken out in silver freshly, and it's only done it by a month or so. Okay? So this is fresh. Don't be shocked if silver does a copper or a lead, or what gold has done repeatedly over the last 50 years, which is to say, blow out the old high by leagues. And gold, for example, the two bull market runs that we have in the last 50 years were both eightfold moves. Bear low to bull high, bear low to bull high. Our bull market started from a low in 2015 at $1,050, in which case you go eightfold, you're going to be $8,500. Just to match the ratio scale of those two prior bull markets. In which case, if silver's 2% of 8,500, again, gold just doing what it's done twice before, an eightfold move, and I don't expect that'll stop it, by the way. But then you run those silver spreads versus gold and say, where might silver be if gold's at 8,000 and silver goes to 3%, like it was in 2011?
$600.
You're talking hundreds of dollars an ounce. And all of these metrics help tell us strongly silver is in a tantrum mode to catch up to a new reality that it's avoided for so many decades, whereas other markets have not.
Yeah.
This is not a normal move. Okay, what about the top? Okay. There are bigger factors going on here than just another bull market in silver. We have an asset class shift that just began out of the strong U.S. stock market, stronger than most in the world. It's a bubble. The monetary metals are broken out freshly. You can expect that breakout of an 11-year wide base not just to go up for a couple months. Mm-hmm. It's going to go up and stay up for a couple years, if not more. I think the events that are about to unfold technically in certain asset categories like U.S. government bond market, Japanese bond market, UK bond market. We have a government debt crisis, and it hasn't really unleashed yet, and I expect it will at some point, probably in the next few months, where you get further downside in those markets. I'm talking long dated, like 30-year bonds.
Okay.
And a spike up in yields on the long end, despite what the Fed does on the short end. That will cause a major bubble-piercing crisis in the stock market. Right now, the stock market has ignored the sustainable high yields that have occurred in the bond market because they're quiet. They're not going up, but they're not going down. And it's when that sleepy market, the T-bond market, which right now is trading like at 115 on the bond futures. You go back to October of 2022 when it collapsed, and it was at 117. So after 3 years of effort to rally the bonds, drop the yields, it hasn't been able to do so. Something's wrong with it. It can't get going on the upside or drop in yields. That's a crisis event pending out there, the kind that could pierce the stock market. And when you do that, that's when panic sets in among central banks, especially when their government bonds are in jeopardy. And the head of the New York Fed, Williams, a month or so ago, said that the Fed is going to, quote, start buying bonds. Oh. His explanation for that was not, that market's in trouble, U.S. government bond market, but it needs liquidity. A polite way of giving an excuse for the Fed to be buying bonds. They've been buying for 2 months and that market has not rallied. So I think it's a pending crisis of huge dimensions.
At the heart of this thesis is silver's long-term relationship with gold. Over the past 50 years, silver has frequently traded at 2% or more of gold's price, with extended periods above 3% and at historical extremes, even above 6%. These weren't slow or orderly moves. They were violent upside surges. We saw this in the late 1970s, and again between September 2010 and April 2011, when silver accelerated geometrically after key ratio thresholds were breached. Today's setup is eerily similar. Silver has spent decades trapped inside a massive range stretching from the late 1970s through 2011, and only recently has it broken decisively above it. That's not how markets top. That's how new secular trends begin. Michael Oliver points out that gold provides the second anchor. Over the last half-century, gold has experienced two major bull markets, both delivering roughly eightfold gains from bear market lows to bull market highs. If gold merely repeats what it has already done twice before, prices move far beyond today's levels. And if silver returns to even a conservative historical ratio, silver prices land deep into the hundreds of dollars per ounce. This isn't theoretical. If gold reaches levels consistent with past bull cycles and silver trades at just 2% to 3% of gold, levels seen many times before, silver doesn't stop at old highs. It obliterates them, and the macro backdrop only strengthens the case. We're witnessing rising stress in sovereign bond markets across the US, Japan, and the UK. Long-dated yields refuse to fall despite central bank intervention, a classic warning sign of a government debt crisis. When bond markets crack, equity markets don't remain immune. Central banks respond with liquidity, printing, and intervention, policies that historically destroy currency purchasing power and supercharge monetary metals. Silver isn't behaving like a speculative commodity anymore. It's acting like a delayed monetary asset finally catching up to a new reality, one it avoided for decades while other markets repriced aggressively. This is not a normal bull market, and it won't resolve in a few months.
Okay, why do I come up with that number? If you take the last 50 years in silver, it was a tenfold range from bear lows to bull highs repeatedly. $4 or $5 lows, $50 highs. Tenfold. Take the dimension of that on a ratio scale and add it to the top of $50. 50 times 10 is what? Okay? You get the point. It's a simple swing measurement of the ratio scale of that range. It would not shock me that if silver goes to a new reality of several $100s, that in getting there, it goes past the new reality in an emotional burst. Markets do that, okay? Overcompensates and then settles back into the new reality. And also at that point, I don't know where we're going to be in terms of the major fundamental crisis that I just mentioned. The government debt bond crisis, the dollar dropping versus other currencies, which it's in the process of doing, the plight that might be suffered by commercial real estate, heavy in debt, long-term debt, not behaving well technically. All these events out there could create a new reality in terms of our fundamental assumptions about where we're going to be in a year or two. We go into a new reality where maybe silver and gold become monetized here, there, suddenly spreading across the world. So their new reality, they stay in. Okay, get the point. This is not a normal bull market. I think silver's going to do what I said, broadly speaking. I can't define it perfectly, except to throw up some of those metrics on silver versus gold. Where has it been before? Hey, maybe we go there again. Why not? Price just took out 50-year high. Where might gold go under a normal bull market? Eightfold. Oh, okay. Is that a big deal? No, you've done it twice before. Times are different now. Maybe it goes further. Silver ratio to gold. Breakout versus the stock market. All these are big macro technical events with underlying fundamentals. And they've just begun.
Yeah.
Similarly, in 79, there was an event like that. But the point is that in the middle of this move that we expect, it wouldn't shock me to see some sort of midpoint where you can say, hey, that's not just a 2-day correction. It wasted 4 weeks, let's say.
Yeah.
Let's say you drop and then you go sideways. It wouldn't surprise me if, pardon me the comment, the idiot price chart technicians say, oh, okay, the range had been roughly $50 range for 50 years. I'm going to add $50 to the top of that range, not a ratio scale, but arithmetic. Oh, it says we're going to double and go to 100. So it wouldn't shock me they're on approach to a big round number, which seems to be the way they like to play the game anyway. Big round numbers are gold and silver. They like to sell against them, see what they can do. That somewhere maybe around 100, you might get that little stumble. It's not going to be the top, especially if it occurs, in January, early February. It's too early in the process. But it wouldn't shock me that there's some kind of a little stumble there. Gold isn't even at its normal 8-fold move. Heck, it's done it twice in 50 years under conditions that are far less horrendous in terms of fundamentals. And it's only 4-fold? We're only halfway to where we were in those two bulls. So if gold goes to 8,000, where would silver be if it's just 2%? Get the point. Okay. Yeah. So hold tight.
$100.
Yeah, easily. And I think that's where we are right now. And so when I hear this constant chorus of that's the top, it's got to correct, got to go back to 50 or 35 or whatever they want, it just doesn't happen. And now the breaks, instead of being spanning a couple weeks or 3 or 4 weeks, like remember October, it wasted about 4 weeks there. This time it was 2 days. Yep. As the stock market has been rising, we're really stalled for 3 months and now is trying to rise again. It's 4 months of sideways S&P. So money's been continuing to go in there, but not at a very healthy pace. And it's all somebody's money has been moving into this sector and preferring it. And we noticed, a couple of months ago, was it Morgan Stanley or somebody, I think it was Morgan Stanley, said that it's time for the 60-20-20 rule instead of the 60-40 asset allocation.
Yeah, they
stocks,
did.
bonds. Instead, 20% should go to gold now. That was a very astute recognition of the new reality.
There will be volatility. There will be sharp pullbacks, pauses near round numbers like $100, and moments designed to shake out weak hands. But history shows that when markets transition into a new valuation regime, they often overshoot first, then settle into the new reality. The real question investors may soon face isn't whether silver can return to old highs, but what happens when those highs no longer define the ceiling at all. If you found this breakdown valuable, make sure to like the video, subscribe, and share it with others watching the precious metals space. Stay informed, stay balanced, and I'll see you in the next one.